Hey guys, welcome to the channel. If you're here for the first time, my name's Christopher Bautista. I'm a broker with the Financial Architects. I've been in the industry for 10 years. And if you're here, we're going to talk about how you can keep more of your money and give less to the IRS. Now the IRS, that's who we want to talk about today. Because why? Who creates all the codes and tells us what we're going to pay when we have to pay it? It's the IRS. And in order to understand them, I always tell people, you got to know how to spell the IRS. Here's how I spell the IRS, okay? It's T-H-V-I-R-S. Theirs, okay? And if you understand theirs and the IRS, and you understand that they care more about what is theirs than what is yours. Let's get right into this, okay? The IRS allows us to do three things with our money. You can get a tax deduction, meaning that you can tax shelter some of your income. If you make $100,000, they allow you to reduce that by putting money in certain buckets, okay? So you don't pay those taxes today. The other thing they allow you to do is to grow your money tax deferred. Now, how powerful is tax deferred growth? That means that they're not taxing the money as it comes out, right? So in this example, if we took $1 and we doubled it every year for 20 years, 1 becomes 2, 2 becomes 4, 4 becomes 8, 8 becomes 16, so on and so forth, how much would we have at the end of 20 years? Guys, I'll do the math for you. You'd have $1,041,000 if we doubled it for 20 years. Now what happens if we take taxes out on the gains as we grow it? 1 becomes 2, that dollar that you gained, let's say it's taxed at 25 cents, okay? Now that becomes 75 cents. So now in the account, you have $1.75. We double that, we take out the gain. We do that for 20 years. How much will you have now? Guess what, guys? You would only have a little over $51,000. You would lose $1 million over a 20-year gain from not having tax deferred growth. That's how powerful tax deferred growth is. Compound interest, if you don't know anything about it, Albert Einstein said, that's the most powerful force in the world today, right? If you understand it, you'll make money from it. If not, you'll pay. The other thing is, number 3, the IRS allows us to get our money tax exempt. Now, you cannot get all 3 in one thing. You get a tax deduction and tax deferred growth, or you pay the taxes now, you grow the money tax deferred, and when you pull the money out, you get that money tax free. How does it work? Let's talk about these buckets, okay? If I said nothing else, where would you want your money? Tax now, tax later, or tax exempt? Most people, when I do these seminars all across the country, they say, I want my money in the tax exempt. No one ever says they want their money here. Yet, we all have our money in these 2 buckets mostly, because people aren't aware. Here's the real fact. Americans don't like paying taxes. We want to keep our hard-earned money, and we feel like somebody's taking it when they pull it out. I remember my first time I earned a check. I looked at my check, I said, who the heck is FICA, right? They took that money, it didn't feel good. And I feel that same way today. So the tax now bucket, or I like to call it theirs now. What's in this account? Your bank account, your savings, your checking, your money markets, your CDs, those are all here. Stocks and bonds, mutual funds, real estate, and your business is all in this category. And guess what? If you have a job, that's in the tax now bucket. The government takes their money now. You guys already know this. At the end of the year, April 15th comes around, they say, last year you made this, your CPA, your tax professional, they tell you, this is what you're paying. The next bucket is the tax later bucket, or theirs later. Now, before I go into that, I want to ask you guys, where are taxes right now? You think they're high or are they low? Most people, I ask this question, they say, I pay way too much in taxes, okay? I pay absolutely too much. I think they're high. Guess what, you guys? The taxes are actually really low. Okay, they're the lowest we're gonna see in our lifetime. When I say that, people are shocked because I say, well, do you know what the taxes have been, how high they've been in history? Well, the truth of the matter is, the highest tax rate ever that the United States charged us was 94% in the year of 1944 and 1945. Obviously, we were coming out of a war. They needed to tax us to pay back what they used in the war. But here's the thing that people don't realize. When this bucket was really created in the 80s, the tax rate in the 70s and the early 80s was 70%, meaning that if you made money, The government, you exposed 70% of your earnings to the government taking it, and you had to get deductions. Here's the truth fact. Nobody likes paying taxes. So back then, if taxes were at 70%, what they were being told was put your money here to reduce your tax exposure, to grow it into the future. The government had a big push to try to reduce taxes for Americans at that time period, which they began to do. In the late 1970s, 1981, people started dumping money in this type of assets, okay? So what they did is they reduced their taxes. They said, I don't want to pay at the 70% tax bracket. I'm going to put some money in here. I'm going to wait till I retire. So this is like the baby boomer. And now when they're retiring, you can see that the tax rate is at the lowest that we will see in our lifetime. In the 80s was the first time, you guys, in the 80s, 1985 was the first time that we were on even plane with the government at 50%, meaning that the government only exposed 50% of your earnings to their taxes. We were socketing money in this, and it was really big. We were being told, put your money in this. You don't have to pay the taxes now, and when you retire, you'll get to keep more of your money. That's the name of the game. How do you get to keep more of your money? Now, let me tell you another thing about these assets, okay? There is a 59.5 rule with this type of money, meaning the government says you cannot touch this money until you reach the age of 59.5. Otherwise, what happens, guys? Bam, you get a slap on the hand, and they penalize you if you pull it out early, right? A 10% penalty tax. Guess what? There's another rule here, guys. There's a 72 rule with money that grows in this bucket. What do you mean? Once you reach the age of 72, the government is forcing you to take money out of this bucket. Why? Because the government knows that we're getting closer to death, and they want theirs, okay? So they force you to take it out at 72. That's called RMDs, okay? Required minimum distribution. What the government does allow you to do right now in 2022 is you're allowed to put $20,500 in this type of an asset right now. So that tells you a little about that. Now let me ask you guys something. Do you think taxes are going to go up in the future, or are they going to go down? I don't want to get into politics. Let me just talk about one simple thing, the national debt. Currently, the national debt stands at $31 trillion. The tax rate system, if you look at this chart, shows that where the taxes are and where they're taxing us has never been wider. That spread has never been wider. So based on just that simple fact and on government spending, where do you think taxes will go? Is this going to be an indication that taxes will go up just a little bit, or are they going to go a lot? If you think they're going to go up even a little bit or a lot, my question is, why are you saying that you do not want to pay taxes today? We know right now, you guys, the tax rate is low. It's the lowest we're ever going to see in our lifetime. More than likely, if you think they're going to go up, this is when you want to pay those taxes. So what do we do, Chris, if we want to avoid the taxes later? Well, you put money here in the tax exempt, or what I like to say is this is your bucket, okay, your money. You socket your money here, this is all yours. Why? Okay, you get to pull your money in here, and when you pull it out, you don't have to pay taxes, but there are some rules. Have you heard of this IRS tax code 408A? 408A is the IRS tax code for Roth IRA. There are some rules with that. The government tells you that you can only get this money tax-free once you reach the age of 59.5. So yes, it does have a 59.5 rule, but guess what? There is no 72 rule because you don't have to pull this money out. It's all tax-free, and they know they're not getting anything from that. Now there's another rule here. You can only contribute every year $6,000. And when you turn 50, you can put $70,000. Now, if we understand compound interest, you're only putting in $6,000 here, and you can put up to $20,500 in their bucket. Which one do you think the IRS wants you putting money in? Obviously this, because they also tell you that if you're in this bucket and you make too much money, over $144,000 this year, they start to phase out and tell you that you can't put money in this bucket. They start to reduce that, okay, if you're single. The other thing here is municipal bonds, guys. You can put money in this, and the income from that's going to be tax-free, but if you sell the bonds, you're going to pay taxes on it. Now, here are 3 tax codes you might not be familiar with: 72E, 7702, and 101A. Chris, I've never heard of these tax codes. Let me tell you what they do. These tax codes are phenomenal. People are unaware of it, but none of the money you put inside of it is taxed. None of the money you put inside of it is reported to the IRS. None of the money inside of this has a restriction on when you can get the money. That means you can access this money at 59.5, and you don't have to spend any of it if you don't want to, right? There is no 59.5 rule. There is no 72 rule. The best part about this, guys, is you can dump as much money into this and there are no income restrictions. So if you're a billionaire, you're a millionaire, you're a trillionaire, you can dump as much money in here. As long as you don't violate the rules, this money always remains tax-free. Now you might be asking yourself, like I did when I first heard about this, how come I never heard of this? Well, if you're wondering that, it's because the IRS sets strict rules on how this type of asset is advertised. This is why you've never heard of it. But you're so familiar with 401k. How familiar are Americans with 401k? Well, right now in 2022, there's over $5.7 trillion in a 401k. The government is loving this because, guys, guess what? You're retiring and so is the government. They love their bucket. They don't like your bucket. Now, this is so powerful in your bucket. This is probably the strongest asset you have here. You have the most freedom with this tax code right here. Guess what, guys? I'm gonna tell you what it is. This tax code right here, these tax codes represent cash value life insurance. That's right, if you're not familiar, you can socket money inside of the separate account of the cash value life insurance. Now, what would that do for us? Let's talk about that. In the numbers, let's pull the numbers up. In their plan, right, the IRS plan, let's say you had a 401k, and when you retire, you have $2.5 million, and to live, you needed $100,000. Now, here's the thing. The IRS, when you pull this out, let's say the tax brackets do not increase, and we're using round numbers, 25% to make it easy. Let's say the taxes are 25%. That means that you get to keep $75,000 under their plan or the IRS plan. What about if you create your plan? Your plan. Let's say you're still contributing to this 401k. You have $1.5 million inside. You're pulling out an income of $50,000. Now this income gets reported to the IRS. You're taxed at 15%. You guys, if you don't know this, if you make less, the IRS takes less. So at 15%, this is what would be yours, $42,500. Now, if you had money in cash value life insurance or a Roth IRA, let's say you had $1 million and you pulled out $50,000 because you're like, Chris, I still need $100,000 income. Well, there is no taxes that come out of this money. You get to keep the full 50. If you combine that, you get $92,500, okay? That means, again, I told you guys, the name of the game is you want to keep more of your money, right? Doesn't matter how much you accumulate. I don't care if you accumulate 2.5 million, how much of it is yours. In this strategy, this diversified strategy, you get to keep more money. Now, a big chunk of money, how will that better your life if you get to keep more of your money? Listen, guys, if you like this information, if you found this helpful, like and subscribe and hit the bell for notifications. Please share the video with your friends, your family. And if you'd like to reach out to me, I can be reached. The information down below, and we can set up a time to chat anytime. I want to thank you guys for coming. Kudos and have a great day. Bye-bye.